Hello, we're joined by Bitfarms. Gentlemen, thank you so much for coming to the mini conference. We're excited to discuss industry and company-specific trends. Would you please introduce yourselves for watchers who are, call it, less familiar with the story?
Thanks, Brian. I'm Jeff Morphy. I'm the president and CEO of Bitfarms.
And I'm Jeff Lucas. I'm the CFO of Bitfarms.
Excellent, thank you. Well, let's kick things off with a topic that's on everyone's mind, and that is the halving. You know, to my mind's eye, I can't recall a halving where we've had such a positive fundamental setup with Bitcoin. Certainly, expectations for hash rate decline, global hash rate decline, have come down quite a bit over the past 2 months. What are your views on how much hash rate might be pushed out of the system, if any?
Well, Brian, I think we shared your views and others' views that before the Bitcoin spot ETFs were approved, we thought there might be 25, 30, maybe even 35% sort of retraction in the online production capacity as older machines were shut off. I think with the ETFs and the price going up to all-time high leading into the halving, we've never seen it before, but we've trimmed down our expectations to more like a 5 to 10% reduction that follows the halving. It won't be instantaneous, but we will see that phased in. But I think really you're going to see the largest miners, the ones that are best capitalized, continue to build, and you're going to see not much of a dent.
Yeah, that seems to be what we're hearing from several management teams, either call it a 10 to 15% decline or not much, not much at all. And do you think the hash rate will recover, over the course of the year following the halving?
Oh, I think it will for sure. Like we're a case in point. We're going from 6.5 exahash with plans to have 21 at the end of the year. Like that's more of a threefold expansion. We know from the public statements from other miners, many are looking to do similar growth targets. If certainly ours is big in a percentage basis, but they're going to be adding, and their machines are ordered. In many cases, they're already paid for. So I think we can fully expect more infrastructure to be built and more miners to be added, very efficient miners too.
Yeah, that's right. So I guess as you're thinking about that broader industry viewpoint, how do you see mining evolving over the next, call it 3 to 5 years?
Well, it is an evolutionary process, and I think as you talked about, Brian, like we've seen these halving epochs that happen every sort of approximately 4 years. Like the first one was for computer nerds, the second one was more for early stage entrepreneurs. The third one in 2020 was driven by scale and really the emergence of the public miners for the first time. And here we are, and we're seeing more with the spot ETFs and adoption. You're really seeing the corporatization, if you will, of what's happening here. And you're seeing more people come in. So as we look into the future, I think that evolution is going to continue. There's going to be more people that understand Bitcoin and the merits of it. So that fifth epoch is going to be more institutional adoption with more banks and pension funds and family offices and the like, wealth funds coming in. So that really the big money is going to come in. That's really where it's going to be fundamentally changed. You're going to see consolidation continue. You're going to see the biggest, strongest companies flex their muscles, gobble up the smaller people, and you're going to see probably a handful of public names that are surviving that are going to get very, very efficient. You're going to see efficiency gains, not just from hardware, but from software and AI and things like this as we bring them into the business to become as efficient as possible and get more higher uptimes. And then probably as you look even further out to the 2032 epoch, more the commercialization. Now that the big money's in, they're going to start trying to roll it out to other people. And it's just going to continue to evolve, and that adoption will start getting into the far reaches of the world.
Yeah, I think that's right. As Bitcoin becomes more and more of an accepted institutional asset class and move into corporate mainstream, and the momentum is there for sure. And we're seeing it here with the ETFs. So let's talk a little bit about your portfolio. What are your key locations and sources of power, and what do you see as your competitive advantage when you're looking at across the peer group?
I'll be glad to take a shot at that here. So first of all, we are a vertically integrated, geographically diversified miner here. We're actually currently in 4 countries. We're in Canada, the United States, and Washington State. We're in Argentina and Paraguay, where we have a very aggressive growth program in place here. So currently the lion's share right now of our operational capacity is in Canada, but that's actually shifting a bit as we're building out even more so now in Paraguay. We have about 10 megawatts in Paraguay, and by way of comparison here, we have around 168 megawatts in Canada, about 20 megawatts in the United States, 54 megawatts in Argentina, as I mentioned, currently 10 in Paraguay. But we have 2 major expansion programs going on in Paraguay because it's a very attractive area with low-cost power here. And we envision that going up to about 160 megawatts, actually, but over the balance of this year here. So we feel that we're right now, we're pretty well balanced, and we will be very shortly well balanced in North America and South America. One of our key advantages here for us is the fact that we are indeed geographically diversified. We have the ability and the capability to go where real electricity costs are the lowest and the most stable. And that's what's made South America for us very, very attractive, because some of the energy costs we're seeing there are a fraction of what they are certainly elsewhere in the world. And by way of example here, in Argentina, where we currently have 54 megawatts, we're paying 2.1 cents per kilowatt hour for electricity. And that's actually with an overall cost about 4 cents for the company in total here. That's obviously a very, very attractive area. And by point of reference here, for us to mine a Bitcoin in Argentina in the fourth quarter, last publicly disclosed quarter, that costs us about $7,700 direct mining cost for 1 Bitcoin here. So you can see how very competitive and attractive it is. In terms of where other competitive advantages are, or sustainable advantages, as we like to call that, a lot of it has to pertain really to both our infrastructure and our operations here. We really play with operational excellence. That's the point that we continually make throughout our whole organization here. And I would argue that one of our strengths here is both the design, the development, and the operation of that infrastructure ourselves. And that enables us to get superior performance overall for all of our activities and our operations here. And by way of example here is that we have a very high uptime, between 96 and 98% here. Our power usage efficiency is some of the best that's out there in the industry. And even a general measure of overall performance, and that being number of Bitcoin mined per month per exahash, we are consistently month after month at the top of the list, if not the top of the list. Going back about 18 months or so. So those we feel are some of the key advantages that we bring in terms of the game, playing the game here that we do.
Yeah, so you mentioned efficiency metrics, Bitcoins per exahash. When you're comparing your portfolio across the peer group, what key metrics are you looking at? You're looking at joules per terahash, I assume, Bitcoin per exahash. Is there anything else that you're considering, or what should investors also be following?
Sure. So some of the broader measures that we look at, first, we do indeed focus on energy costs, that being both the cost per kilowatt hour, but secondly, as you point out, the efficiencies here. And as a matter of fact, we've just launched and announced some major programs here. We're making major inroads in upgrading our miners here. We're actually going to be bringing our efficiency down from about 35 watts per terahash currently down to about 21 by the end of this year here. And so that's actually more than a 1/3 fold increase in terms of our operating performance in our electrical efficiency going forward. But the measures and the way we look at it is really sort of twofold. One of which is we look at it per terahash. So you often hear the term, what is the hash price? Which is that is, per day, how many cents per terahash in terms of revenue. We also look at our electricity and at our fixed or operating expenses as part of that as well. And to give you some examples here, in the fourth quarter, we are around 3.6 cents per terahash with the cost of electricity. Now, just keep as a point of reference here, currently in advance of the halving, right now, the hash price is around 10.5 to 11 cents. And then we also look at our operating expenses or our fixed costs per terahash, and that was around 1.2 cents actually per terahash in the fourth quarter as well. So we did achieve pretty attractive margins. As part of that math, we then also take a look at what is the actual cost per Bitcoin. And we take a look at both the energy costs and the fixed costs for the total cash cost as well here. What's very exciting for us about this upgrade program that we've announced is twofold. One of which I mentioned, that we're reducing our costs from about 35 watts per terahash down to around 21. And secondly, here we're going to be increasing our hash rate, tripling it effectively from 6.5, where we are currently, to about 21 exahash by the end of the year. So that's going to help us in many ways. One of which is with the halving coming up here clearly, that while the halving you could say approximately is going to reduce, the revenues, so to speak, by 1/2, we are more than tripling our hash rate. So we're actually going to be experiencing a growth in our market share overall. So the benefits to us, by way of example here, is even if you assume that on the hash price, the revenue per terahash may go up from about 11 cents today down to, let's say, 5.5 for simplicity purposes here after the halving, our electricity cost per terahash will be going, as I mentioned, about 3.6 cents today down to 2.5 and even down to 2.1 cents we're planning by the end of the year. Secondly, with a larger market share and mining more Bitcoin here, our fixed cost per Bitcoin will also be going down and per terahash. And we see that going down from 1.2 cents down to about 0.8 cents. So what that means that even after the halving, with the current economics and the halving in place here, we're going to be achieving cash mining margins of between 40 to 50%. So overall, we see ourselves being in a very attractive position once we have this upgrade in place here.
Yeah, that's a very impressive margin level, and certainly, I think one of the most compelling aspects of investing in miners is that you get that leverage to Bitcoin, but you also get Bitcoin at the cost of mining, right? So you're able to capture that margin. And we touched a little bit earlier on public company exahash growth. I guess what are your plans regarding growth and improving efficiency, and what are your views on whether or not companies need to lock in rigs with forward contracts? Because I know we had discussed that a little bit, and I think that might be beneficial for our viewers to hear your thoughts.
So again, just to repeat some of the key measures and targets that we have corporate-wise for the year here, as I mentioned, we're going to have a 1/3 improvement in our efficiency from 35 to 21. We are again achieving electricity costs around 4.1 cents, and there may be further opportunities for improvement, particularly with Paraguay and the stability of energy prices that we're seeing there and the opportunities here. The second major point being, again, that our exahash is going up by threefold, which is going to have a material impact both on our fixed costs, but overall economics going forward. So those are some of the key measures from addressing your question here.
Let me jump in just a little bit. You asked about whether it was important to fix prices on the miners. And having been through this before as a almost 7-year-old company, the memories of 2020 still ring in all of our ears. And we saw how when the Bitcoin price started to really rally back in late 20 into 21, you would have 24 to 48 hours to lock in a price of a Bitcoin miner before the price went up. And you just needed to make snap decisions. We kind of were surprised that hasn't been the case this time. Part of that's a demand supply situation, but with these new miners and with the way price Bitcoin going, we definitely believe that the cost of miners is going to go up. And we have locked in our full supply of miners at these very attractive prices, these introductory prices back in November, December, January, so that we have locked in our prices right through to when we build out to 21 exahash per second by the end of the year. We think that's very important. This allows for payback periods of a year, under a year, and that's one of our primary performance things. So if Bitcoin prices go up by a third or double, like your payback period, especially with the halving, is just going to be that much longer. And it's one of the important sort of stewards of capital things that we go through when we look at these type of capital acquisition strategies.
Yeah, very good. Just shifting gears here a little bit. There's been an industry shift toward vertical integration, from call it asset light, call it miner owner, renting out plugs. Do you see that trend continuing on a broader basis, looking at the industry? And do you think that, call it over the next few years, those relatively asset light players will be weeded out, due to efficiency gains on the other side?
Well, you sure see the change that's afoot right now, but some 7 years ago, we were one of the originators of the full vertical integration model, and we saw the importance of it back then. And we haven't differed in our viewpoints here. Having teams that are operationally focused, know how to find and negotiate power purchase agreements, find sites, build sites, be responsible for all the construction aspects and the costs associated with them, buying miners, all the logistics with miners, bring them in, set them up, make sure all the switches and the IT are there, having the software to accompany all this. This was part of our ambition from our founders all those years ago, and we've been through halvings before. We have put more good people in our teams that have been together for now 2, 3, 4 years. Some of our employees are just had their 6-year anniversaries. But it's that type of operational focus that allows us to control so many more aspects of our business and drive out efficiencies. We think these asset light models, because they have less control of their business, don't have the opportunity to really wring out these savings and the efficiencies like we've been doing for years. And that's why we have month over month had some of the best efficiency achievements really since all these things started being recorded for the industry. We're very proud of that, and we continue to put investment and endeavors in place to further improve our efficiencies. And that can only occur if you're vertically integrated and all your pieces are continuing and you really quarterback a successful football team of a lot of different moving pieces.
And by the way, that focus, if I can just add, on infrastructure allows us to be geographically diversified, because we can go into foreign lands here and look at the secret of the game that we play here is that where do you want to get the cheapest electricity and the most stable electricity costs? And our arena is in essence the whole world, versus just being isolated in one particular state perhaps or otherwise here. And the fact that we've got so much experience in both designing and building these operations here means we can go into a place like Paraguay or Argentina and hit the ground running and put these things up very quickly, on time, and often under budget.
Yeah, very good. And I think that certainly investor desire for vertical integration and greater efficiency will continue to grow, and managements rather continue to move in that direction where you've already been. I guess as our final question, as we're heading into the halving and Bitcoin has been on a tear over the course of the past 2 months, what's your viewpoint on hodling? How do you view exposure to coin?
Let me start off, and then Jeff, you can certainly fill in afterwards. Because we do actually have a pretty thoughtful, we think, HODL treasury philosophy here. So it's interesting, when we first began this business, I think investors often viewed miners as a leveraged play on Bitcoin, which still exists, and secondly, a means of investing in Bitcoin far more conveniently than they could otherwise here. Now, obviously, what's happened with the spot ETFs has changed that over the past several months here. But in terms of how we actually view our HODL here, more important than anything else, we really focus on getting that leverage, from the price and the rising price of BTC through our operations itself here. And we, in many respects, sort of view the Bitcoin that we mine, which is in excess of our operating cash requirements here. We use that actually as a very efficient and inexpensive means of funding our growth going forward. So one of the things that we've actually put in place here about several months ago is called the synthetic HODL. So when we're mining Bitcoin above our operating cash requirements for that business, what we'll do is we may sell a Bitcoin, use 90% of those proceeds to fund our capital expenditures and our growth here. And by so doing, we're doing it far more cheaply, certainly, than the cost of equity, from raising that money up in the marketplace. But secondly, we may take 10 or 15% of those proceeds and buy long-dated call options. So the benefit for us of doing so is twofold. On the one hand, we get the cheapest form of capital to fund our growth going forward here. And secondly, we maintain, in essence, the upside of the Bitcoin that we just sold. And that's a very effective program that we have in place.
Yeah, that's a very compelling viewpoint and somewhat unique among the answers we've received from the managements at the conference. Gentlemen, this has been a wonderful, I think, use of time and conversation. Thank you so much for carving out this time today, and we hope to have you again very soon.
Thank you, Brian.
Thanks, Brian.
Thank you.
Take care.